What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis for Abbvie stock. In the last year, this stock is up now only 21%, but that's because it recently suffered a big drop. As of about a month ago, the stock was up 48% on the year. So, we're going to get into whether or not this is a good stock to invest in and how the valuation looks at the moment. So, the market cap is $291 billion. This is a big company. The revenue for this company is 54 billion, at least last year. Trailing 12 months, we're looking at 55, so a slight increase. And then next year they're supposed to do 56. So again, they're growing at like 3 to 4% per year. And for net income, we're looking at numbers of 4.8 billion. As you can see, not super consistent. I mean, 4.8 billion last year is what they were doing over 10, 15 years ago. So I don't really, that doesn't really interest me when I see that. How are they doing for trailing 12 months now? Still down 5.1 billion. See, the net income is weak. The net income is weak. I mean, that's with increasing revenue. So that means that margin is getting worse and worse. What's their margin looking like? ROI 13%. And again, it was 32 12 years ago. Profit margin 9%. As you can see, it's pretty much gradually getting worse over the last 15 years. So that's just a bad sign. That's a long-term trend that is trending downwards. That's not what we want to see. Shares outstanding, trending up. That's not what we want to see. Dividend, consistent, and it keeps increasing. That's good. Cash and debt ratio, very bad. 52 billion in debt, 12 in cash. Let's see if the updated version is any better. No, it's actually worse. Now we're down. They just spent 6 billion in cash and their debt is the same. So now they're down to 7 billion in cash and 58 billion in debt. So we are talking a company that's doing 5 billion on the bottom line and they have 50. That means if they spent all their money every year, it would take them 10 years to pay off their debt. So we're off to a pretty bad start with this stock. Now let's see, the last 5 years, I would think the stock should be down the last 10 years or so. But really, the stock's up 88% in the last 5 years. I don't know how you would justify that. I don't think revenue, I don't see how higher revenue but lower margin and the bottom line being flat is a good thing to have. How is free cash flow? So free cash flow is a little bit more consistent. Okay, that makes a little bit more sense. Free cash flow is more consistent. Let's see. What about adjusted for stock-based compensation? Because they were adding shares. Okay, so still not bad. That's not bad. If we take a look at their PE ratio, it's very high right now. Like I was saying, net income is flat, but the stock keeps going up. That's why we have a 58 times earnings right now. So this is just, I don't know. It doesn't really interest me. Does not interest me. So that's pretty much all the analysis I need to do for this stock to know that I am not interested. They have bad long-term trends, and so not a stock I'd be interested in buying. But thank you for watching, and I will see you guys in the next video.